Welcome. Today we're diving into the world of exchange-traded funds or ETFs. Over the past 2 decades, ETFs have become a go-to investment tool for millions, offering flexibility and cost-effectiveness. But as with any financial product, it's important to look beyond the surface. In this video, we'll explore the key advantages that have made ETFs so popular, as well as some unexpected disadvantages that every investor should consider. Whether you're new to investing or looking to fine-tune your portfolio, understanding both sides of the ETF story is crucial. Let's start by exploring why ETFs have captured so much attention in recent years. ETFs have exploded in popularity for good reason. They offer a flexible, cost-effective way to build wealth, making them attractive to both beginners and seasoned investors. But before you invest, it's important to weigh the pros and cons. ETFs aren't perfect, and understanding their strengths and weaknesses can help you make smarter decisions. In the next scenes, we'll break down exactly what an ETF is and why so many investors are choosing them over other options. What exactly is an ETF? An ETF, or exchange-traded fund, is an investment fund that holds a diversified basket of assets, like stocks, bonds, or commodities, and trades on an exchange just like a stock. Unlike mutual funds, which can only be bought or sold at the end of the trading day, ETFs can be traded throughout the day at market prices. This makes them a flexible option for investors who want real-time access to their investment. Next, let's look at some of the biggest advantages ETFs offer. One of the standout advantages of ETFs is diversification. With just one purchase, you can gain exposure to hundreds or even thousands of securities. This built-in diversification means you're not putting all your eggs in one basket. Instead of being overly exposed to a single company, sector, or region, your risk is spread out. This helps stabilize your overall returns and can make your investment journey less stressful. Diversification is a key reason why many investors choose ETFs as a foundation for their portfolios. Another major benefit of ETFs is their low cost. Most ETFs have much lower expense ratios compared to actively managed mutual funds. Why? Because many ETFs are passively managed, simply tracking an index rather than trying to beat it. This means less oversight and fewer management fees eating into your profits. Over time, these savings can really add up, making ETFs a cost-effective way to invest for the long term. Tax efficiency is another area where ETFs shine. Thanks to their unique creation and redemption process, ETFs typically generate fewer capital gains distributions than mutual funds. This means you're less likely to get hit with unexpected tax bills, helping you keep more of your earnings over time. For investors focused on maximizing after-tax returns, this can be a significant advantage. Like mutual funds, which only trade once a day after the market closes, ETFs can be bought and sold throughout the trading day. This intraday trading flexibility allows investors to react quickly to market news or adjust their portfolios as new opportunities arise. For those who value the ability to make timely moves, this is a key advantage of ETFs. ETFs open the door to a wide variety of asset classes. Whether you're interested in US stocks, emerging markets, gold, real estate, or even cryptocurrency, there's likely an ETF for you. This versatility makes it easier to build a diversified and balanced portfolio, no matter your investment goals or risk tolerance. Transparency is another strong point for ETFs. Most ETFs disclose their holdings every day, so you always know exactly what assets you're invested in. This level of transparency allows you to track your investments closely and make informed decisions. In contrast, some mutual funds only reveal their holdings quarterly, leaving you less in the loop. ETFs are especially beginner-friendly. With just one ETF purchase, a new investor can gain exposure to an entire index like the S&P 500 or a specific sector such as technology or healthcare. This means you don't need to spend hours researching individual stocks. ETFs make it easier for newcomers to start investing with confidence and build a solid foundation for their financial future. While ETFs are known for low expense ratios, it's important to remember that trading costs can add up. If you're frequently buying and selling ETFs, brokerage fees and commissions can quickly eat into your returns. For very active traders, these costs may reduce the cost advantage that ETFs are known for. It's wise to keep an eye on your trading habits to avoid unnecessary expenses. Because ETFs trade like stocks, their prices can fluctuate throughout the day. This exposure to market volatility can sometimes tempt investors to make emotional decisions, such as panic selling during market dips. Such reactions can undermine your long-term investment performance. Staying disciplined and focused on your goals is key when investing in ETFs. ETFs are designed to track an index, but sometimes their performance doesn't perfectly match the benchmark. This difference is known as tracking error. It can be caused by management decisions, fees, or imperfect replication of the index. While usually small, tracking errors can impact your returns, so it's something to watch for when selecting an ETF. Diversification is generally a good thing, but it's possible to go overboard. Owning too many overlapping ETFs that track similar indexes can lead to redundancy. This not only diminishes your returns but can also make it hard to know exactly what you're invested in. It's important to review your portfolio regularly to avoid unnecessary overlap. Some ETFs, like leveraged, inverse, or thematic funds, are more complex and can be riskier than traditional ETFs. These specialized products may not perform as expected, especially over the long term, and can result in significant losses for unprepared investors. It's crucial to understand exactly what you're buying before investing in these types of ETFs. When you invest in an ETF, you don't get to pick and choose the individual securities it holds. If the fund owns companies you prefer to avoid, whether for ethical reasons or poor performance, you're still indirectly exposed to them. This lack of control is something to consider, especially if you have strong preferences about your investments. Large ETFs are usually very liquid. Some niche or sector-specific ETFs may have lower trading volumes. This illiquidity can make it harder to buy or sell shares at a fair price, especially during periods of market volatility. Always check the trading volume and liquidity of an ETF before investing, particularly if it focuses on a narrow market segment. ETFs are a powerful tool, but they work best as part of a broader investment strategy. Balancing ETFs with other vehicles like individual stocks, bonds, or mutual funds can give you more flexibility, stability, and control over your portfolio. Diversifying across different types of investments helps you manage risk and pursue your financial goals more effectively. Choosing the right ETF involves looking at several key indicators. Pay attention to the fund's expense ratio, liquidity, tracking accuracy, and the underlying index it follows. Reviewing the fund's history and assets under management can help you confirm that it's established and efficiently managed. Taking the time to research these factors can make a big difference in your investment outcomes. Even though ETFs are accessible to most investors, working with an experienced financial advisor can be invaluable. An advisor can help ensure your ETF choices align with your financial goals, risk tolerance, and tax strategy. Good guidance can help you avoid costly mistakes, especially if you're building a diversified portfolio for the first time. It's important to remember that ETFs are tools, not guarantees. They offer many advantages from diversification to low fees, but they aren't a one-size-fits-all solution. Understanding their strengths and weaknesses will help you use them wisely and avoid common pitfalls that could derail your financial ambitions. Let's quickly recap what we've learned so far. ETFs are investment funds that trade like stocks and offer a simple way to diversify your portfolio. They're known for low fees, transparency, and flexibility. However, they also come with risks such as trading costs, market volatility, and potential complexity. Keeping these factors in mind will help you make more informed investment decisions. ETFs are structured to track a specific index or asset class. They use a unique mechanism called creation and redemption, which helps keep their market price close to the value of their underlying assets. This structure is what allows ETFs to be both flexible and tax-efficient, setting them apart from traditional mutual funds. Most ETFs are passively managed, meaning they simply track an index. However, there are also actively managed ETFs where managers try to outperform the market. Passive ETFs tend to have lower fees, while active ETFs may offer the potential for higher returns, but with greater risk and cost. Knowing the difference can help you choose the right ETF for your strategy. In comparing ETFs, always check the expense ratio. This is the annual fee charged by the fund, expressed as a percentage of your investment. Lower expense ratios mean more of your money stays invested and working for you. Even small differences in fees can add up significantly over time, so it pays to shop around. Liquidity refers to how easily you can buy or sell an ETF without affecting its price. High trading volume usually means better liquidity, making it easier to enter or exit positions at fair prices. Always check an ETF's average daily volume before investing, especially if you plan to trade frequently. Tracking error measures how closely an ETF follows its benchmark index. A low tracking error means the ETF's performance is very similar to the index, while a high tracking error indicates more deviation. Understanding this metric can help you choose ETFs that deliver the results you expect. Thematic ETFs focus on specific trends or sectors like clean energy or technology. Leveraged ETFs use financial derivatives to amplify returns, sometimes aiming for double or triple the daily movement of an index. While these can offer exciting opportunities, they also carry higher risks and may not be suitable for long-term investors. Inverse ETFs are designed to move in the opposite direction of their benchmark index. They're often used by investors who want a profit from market declines. However, inverse ETFs can be complex and risky, especially if held for more than a day. Make sure you fully understand how they work before investing. Sector ETFs focus on specific industries like healthcare or technology, while niche ETFs target very specific themes or markets. These funds can help you capitalize on trends, but they may also be more volatile and less liquid than broad market ETFs. Always consider the risks before investing in specialized funds. International ETFs allow you to invest in markets outside your home country. They can provide exposure to global growth and diversification, but also come with risks like currency fluctuations and geopolitical instability. Balancing international ETFs with domestic investments can help you build a more resilient portfolio. Commodity ETFs track the price of physical goods like gold, oil, or agricultural products. Real estate ETFs invest in property-related assets. Both types can add diversification and inflation protection to your portfolio, but they also have unique risks such as price swings and sector-specific challenges. ETFs can play a key role in tax-efficient investing. Their structure helps minimize capital gains distributions, which can reduce your tax bill. However, it's still important to understand the tax implications of your specific ETF holdings and consult with a tax professional if needed. ETFs make it easy to rebalance your portfolio. By buying or selling ETF shares, you can quickly adjust your asset allocation to stay aligned with your investment goals. Regular rebalancing helps manage risk and keeps your portfolio on track, especially as markets move over time. While ETFs offer trading flexibility, overtrading can be a pitfall. Frequent buying and selling may lead to higher costs and emotional decision-making, which can hurt your long-term returns. It's important to have a clear strategy and avoid reacting impulsively to short-term market movements. ETF liquidity depends on both the trading volume of the ETF itself and the liquidity of its underlying assets. Highly liquid ETFs are easier to trade at fair prices, while illiquid ones may have wider bid-ask spreads. Always check both factors before making a trade. Owning multiple ETFs that track similar indexes can lead to portfolio overlap. This means you might be more concentrated in certain stocks or sectors than you realize. Regularly reviewing your holdings can help you avoid unintended risks and maintain true diversification. Daily disclosure of ETF holdings gives investors a clear view of what they own. This transparency helps you track your investments and make informed decisions. It's a major advantage over some mutual funds which may only report holdings quarterly. ETFs can be a great fit for retirement accounts like IRAs or 401(k)s. Their low fees, diversification, and tax efficiency help maximize long-term growth. Just be sure to choose ETFs that align with your retirement goals and risk tolerance. Dollar cost averaging involves investing a fixed amount at regular intervals, regardless of market conditions. ETFs are well suited for this strategy, allowing you to build your position over time and reduce the impact of market volatility. Many brokerages offer automatic investment plans for ETFs. This makes it easy to set up recurring purchases and stay disciplined with your investing. Automating your investments can help you stick to your plan and reach your financial goals faster. Regularly reviewing your ETF performance is essential. Compare your ETFs to their benchmarks and check for tracking errors or unexpected changes in holdings. This helps ensure your investments are still aligned with your goals and performing as expected. ETFs can help manage risk by providing diversification and access to different asset classes. However, it's important to understand the specific risks of each ETF you own, including market, sector, and liquidity risks. A well-balanced ETF portfolio can help you weather market ups and downs. ETFs are a powerful addition to any investment plan, but they should fit within your overall strategy. Consider your goals, time horizon, and risk tolerance when choosing ETFs. A thoughtful approach will help you make the most of what ETFs have to offer. Summary: ETFs offer a range of benefits, from diversification and low fees to transparency and flexibility, but they also come with risks and complexities that shouldn't be overlooked. By understanding both the advantages and disadvantages, you can use ETFs as effective tools to build and manage your wealth. Remember, the best investment decisions are informed ones. Thanks for watching and happy investing. Welcome. Today